This is Professor Milligan, and today I'm going to walk you through what a synthetic is and how to trade synthetics. What is a synthetic? A synthetic is an investment that is meant to imitate another investment. Basically, we can take two or more securities and duplicate or replicate another security. That's a synthetic. Synthetic positions can allow traders to take a position without laying out the capital to actually buy or sell the asset. In short version, we use options to create synthetics. And by using these options, we can recreate a stock or a bond or a convertible bond. Basically, the sky is unlimited. The last bullet point here says synthetic products are custom designed investments that are created for large investors. Well, you don't have to be a large investor to actually create a synthetic. I'm not a large investor and I do it all the time. What you're looking at right now is the S&P 500 ETF, the SPY, on an all-cash trade or margin versus a bullish synthetic position on the S&P 500. But what you're looking at right now on the left-hand side here is the S&P 500 closed on September 18th, 2020. When I put this together, grab the numbers. S&P 500 SPY closed at $337.44. 100 shares would have cost you $33,744 in cash, or on margin $16,872. This was a all cash or on margin transaction. Here on the left is a bullish synthetic. I'm marrying a long 338 call, which costs $7.05, and I'm short the 338 put, which costs $8.61. So here's how the synthetic works. If the stock goes up, you'll make money. Well, if the stock goes up, the SPY goes up, this position will make money on the call. The risk on this stock on the SPY is if it drops. And if it drops, we'll lose money. Well, if it drops with our synthetic, we'll lose money on the actual short put. These two securities together, the long call and the short put, literally mirror the S&P 500. I chose a strike price, 338, right near where the stock is trading at 337. Now, here's where the numbers get interesting. This call cost $705. This short put in your pocket $861. Therefore, this bullish synthetic is not going to cost you anything. And in fact, this bullish synthetic will put $156 in your pocket. And I'm repeat again, both positions are basically the same. They have the same upside potential as well as the same downside risk. The stock itself, if it goes up, will give you a nice return. But as you can see, this synthetic will give you more return. And the reason being is you've got control of these 100 shares of the SPY, but you didn't have to put any money up. You have control of them. On the left, you're going to see our short position on the SPY, the S&P 500. On 100 shares, on margin, which is what's required, you have to put down $16,872 on margin. And again, the cash is $33,744. On our synthetic side now, because we're bearish and puts go up as the value of the underlying asset goes down, we're going to be long the put, the 338 put. Again, strike price is right where the stock is currently trading, the ETF is currently trading. So we'll make money on our long put if the security drops in price. And we'll lose money if the security goes up in price on our short call. This bearish synthetic is actually mirroring a short position in the S&P 500 SPY. Now, in this particular case, the synthetic will cost you $167. In our synthetic position, you're getting control of 100 shares of SPY at a cost of $167, as opposed to $16,872 on margin. Now, these options will expire September 18th, so you have 37 days. So the downside to this strategy is that you believe that the stock is going to drop in price over the next 37 days, and that's where you're going to make your money. And once again, both positions basically have the same upside potential and the same downside risk. In these positions, If you're short, the most you can make is $337 on the short stock, or if you're long the put, the most you can make is $338. In other words, the stock goes to zero. Your loss, though, unlimited loss potential. And the reason why you have the same unlimited loss potential is the stock could go to infinity. Every dollar the stock goes up, you lose money. But again, in this case, our synthetic is duplicating that security for $167 for the next 37 days. What I did now was, and you guys always hear me talk about this, I'm always talking about that when you take these positions, one of the things that you have to do as an investor is you have to manage your risk. If you're not managing your risk, your downside is when you're going to get really hurt, could lose all your money, lose your portfolio. So what I did was I put together a long position in the SPY, which you've already seen, as well as a long position in our synthetic, and then I hedged both of them. So let me explain. If you look to the left, you'll see once again, we're long the SPY stock, the S&P 500, at $337.44. We're long 100 shares. We married to that a long put with a strike at 337. It's going to cost us $8.25 for this put option for our 100 shares. So what this means is our break even on the stock with the hedge is going to be $345.25. Because we had to pay for this put option, our cost on 100 shares now is $34,569 in cash, or $17,697 on margin. On our long hedge position, we have unlimited upside potential. Our maximum loss is $869, and that's if the stock, I guess, goes straight down. So in other words, the most we can lose on this transaction, if we buy this stock and hedge it, is $869. Now on our synthetic side, once again, we're long the 338 call. We're short the 338 put. That's our synthetic. Our hedge, just like we did on the stock, we're hedging it with a long 337 put at $8.25. Again, that's going to cost us $825. You'll notice, though, that the break even on our synthetic is actually a little lower, $366.69. I want to pause here for a minute. One of the reasons why I like using synthetics is it lowers my cost as opposed to buying the stock. The next thing you'll see is that the hedge will cost us a total. This whole synthetic hedge position will cost us $669. And just like the stock position, we have unlimited upside. But you'll notice our maximum loss is $679. Our maximum loss is the $669 that we spent for the positions, and the dollar spread between the two puts. That dollar spread is another $100. So our max loss is $679. And then once again, we have 337 days for this to happen. Both positions, again, have the same basic upside potential as well as the same downside risk. This is a hedged synthetic. This strategy does work, but again, it works if you're a good stock picker. In other words, you still need the market to go in the market of the stock to go in the direction that you're looking for it to move. In fact, I use this same synthetic hedge strategy in commodities. And the reason being is volatility has become my friend. Because I've hedged my downside risk, I can go after things that are very volatile. And in fact, I want volatility because I've reduced my risk. And if I'm right, I want a big move. What you're looking at now is the S&P 500 options. These are the options I use to put together my synthetic. On the left-hand side are the calls. You can see they start at 335 and work their way up to 340. On the right-hand side are your puts. Now, I worked with the $38 calls and puts and the 37 puts. So these are the strikes that I used, and you can see the prices. So I put this up here so you guys can actually see the numbers, see the prices I was working with. On this page, I put together some definitions on options for you so you can familiarize yourself with some of these terms and terminology, especially for the newer investors who have not traded options before or not too familiar with options. Make sure to follow me on my Professor Milligan Instagram account. I go live every Wednesday from 1 to 2 p.m. Pacific Standard Time, basically right after the market closes. And I also post a number of videos on my YouTube channel at Professor Milligan. So make sure to follow me.